Hey guys, welcome back. This is another episode of Sammy Trading Hub. I believe you've been following previous episodes, and today's episode will be talking about daily A.M.D. This episode is quite similar to weekly A.M.D, but just some few changes, right? Okay, so sit tight, grab your pen and your notes. I always encourage people to learn like that. I don't want you to just watch this video like you're watching some videos on Netflix. You want to be with your chart, you want to write down anything you're hearing for the first time. Okay, so let's dive in. So daily A.M.D, just as the weekly cycle has three phases, so does the daily, right? So I've talked about this before when I was teaching about weekly A.M.D. I see the weekly A.M.D is not just cycles, like it's not just doesn't just work only on the weekly cycle, right? It works on the monthly, the yearly, and also the daily. So the same thing you do on the weekly, like weekly bias, that's the same thing you want to do for the daily bias to get your main direction. Okay, so A.M.D simply means accumulation, manipulation, and distribution, for those who might have missed it. And if you're just watching this, this is the first video you're watching on this episode, I'd like you to either watch this finish or go back and start from episode 1 so you don't get misled, right? So a current day is attracted to a previous day's draw on liquidity. So if you have a new day, that day will be attracted to a previously drawn liquidity to actually make the main move, right? We're going to talk about that soon. So just as the weekly, when a new day opens, it accumulates in the Asian session, which is within 1900 to 100 New York time. That's 19 o'clock to 1 o'clock New York time. This 19 is around 7 o'clock here to 1 o'clock. Not Nigerian time, not your country time, just New York time. So if you are not setting, if your trading view is not, your trading view time zone is not on New York time, you're going to be misled with all the lectures on this channel, right? So you want to go to trading view and change your time zone to New York. So from this particular time, this is where the Asian session situates. New York 7 o'clock to 1 o'clock midnight, right? So that is where the accumulation begins. The manipulation phase mostly occur within London Q zone. Many people have been hearing about London Q zone, but you don't actually understand the narrative around that London Q zone. London Q zone is mainly or mostly the manipulation phase for the day, which is within 2 o'clock to 5 o'clock New York time, right? 2 o'clock to 5 o'clock New York time, that's London Q zone. So at this particular time of New York session, 2 o'clock to 5 o'clock, that's when the manipulation phase occur. But most people want to trade this phase. This particular phase can be tradable, yes. But where is the main move, the big move? That's the distribution phase. Distribution phase is always the last phase, and it's always the one with high volatility. So the distribution phase mostly occurs within the rest of the day. So after the Asian session where price accumulates and the London Q zone where price manipulates, then the distribution phase occurs within the rest of the day, right? So if bullish, most times high of the day are formed within 15 o'clock to 16 o'clock. That's 3 to 4. Most times if you are bullish, if you have a bullish day, most times the high of the day is formed within this time, New York time. If bearish, most times the low of the day are formed within 15 to 6, still the same time with the high of the day if bullish. So if bearish, you should be expecting the low of the day around 3 o'clock to 4 o'clock. Don't take my word for it, go and study, go and check your notes, right? Go and check your notes. So time and price, many people have been hearing about time and price. You might have been hearing about time and price, but you don't actually know or understand what it means by time and price, right? Well, I'm going to break it down a bit for you today. So the most important factor on the chart is time. Yeah, you can argue as you like, but believe this, the most important factor on the chart is time, not your candlestick. Combining time with price is excellent. That is the gem. That is where you see clear precision or clarity, right? So there are certain times in a day where the volatility of the market is high, and times like these can yield high probability setups. So you want to trade at this particular time of the day where there is high volatility. I see some guys going to trade the Asian session, which you are known today, if not before, that it's a manipulation phase, accumulation phase. And you know what mostly occurs in an accumulation phase? Consolidation. So you going to trade in a consolidation is like very low probability. You're getting only low probability setups, right? So that's just it. Now, one of the most common is the London Q zone, equities open, and the New York PM. So these are the most common volatile time of the day when it comes to forex trading. I don't really know about crypto, because crypto can be manipulated, right? Can be manipulated by so apart from high impact news, these times of the day are very, very volatile. The London Q zone, which I said earlier, is 2 o'clock to 5 o'clock New York time, and the equities open, which is mainly 9:30 New York time. That's 9:30 a.m. New York time. And then New York PM, that's after the launch time. If you've been around this channel for quite some time, you understand what I mean by launch time. That's from 12 to 1. After that one, we have the New York time from 1:30 to 3 o'clock. Then 4 o'clock, you should be done with your trading or whatever for the day. So all these times of the day can be very volatile without any news impact. Also, it's best to avoid news volatility, as it causes sudden rush of volatility in a very small amount of time. So it's very, very, very important. If you are trying to practice your strategy, or if you are new, it's very important to avoid high impact news. This can cause very high volatility in a very small amount of time. When I'm talking about the times of the day that are volatile, I'm not including high impact news. London Q zone is mainly 3 hours stretch. Equities open 3 hours stretch. The New York PM 3 hours stretch, right? But when it comes to high impact news, it can be very, very volatile in matter of 3 minutes, 5 minutes, 10 minutes, just like that. So you don't want to be in this kind of market, because sometimes it can be very indecisional, right? So now these are a very clear example of what price does in a day. It might have a different behavior to this, but this is kind of what it does, right? So we have the accumulation, which I mentioned earlier. This is mostly done at the New York, in the Asian session. So you have that 7 o'clock New York time to 1 o'clock midnight. Price is what accumulating. So price manipulates towards previous day drawn liquidity. This previous day drawn liquidity, I'll come to that. Can be FVG, can be BSL, can be SSL, whatever. So price manipulates, and this manipulation mostly occur in the London Q zone. Mostly, not every time. Okay, it mostly occur in the London Q zone. Then the distribution is the rest of the day. Then 3 to 4, price forms the low of the day in the distribution phase. So you should understand this particular phase in a daily cycle. This is not really easy to spot out. It takes time, it takes months, it takes weeks of practice, right? So you don't just take my word for it and go and start trading. You want to go and study first, so you understand these things, right? So now this is a very bullish diagram of the daily cycle. So price accumulates in the Asian session, manipulates on the London Q zone. Mostly this manipulation occur in New York AM session, then distribution at PM. But you want to be very certain at where price is going for the previous day drawn liquidity. Then after that, price now boom rallies the rest of the day. Has the distribution phase. So this is the high probability setup. There are some guys who catches this setup. Yes, fine, but this is always the high probability setup. You always want to train yourself to go every day to catch this particular setup. Understanding the narrative of why price does what it does is far better than cramming structures. I've said this different times. if you understand the narrative of the why price is coming from a particular area or where price is running to, then it is far better than cramming structure, because sometimes the structures might give you might occur in a counter trend. Like this is a very counter trend and you are seeing your structure, but it's a counter trend and you take it and you're countering the trend before you know, boom, you're taking out. So you want to understand the narrative, not just the structure, because the narrative is what forms the structure, right? Just like you saying you're not trading indicator, you want to trade price action. So it's the same thing. So narrative is what forms the structure. So you want to understand the narrative itself, why price does these structures. Okay. So when a new day starts, what are you looking for? First question you should ask yourself. So if you can answer this question to yourself, no problem. But I'll answer this question at the end of this video. So don't skip, don't leave. Simple draw on liquidity can be a buy-side liquidity, sell-side liquidity, or imbalance. Note that or write it down. If you can store it on your head, you store it. Simple draw on liquidity can be a buy-side liquidity, sell-side liquidity, or imbalance. There are different types of imbalance, different types of inefficiency, however you call it, and I'm going to talk about that. So these zones act as magnets to price. Right, price are magneted to these zones, these particular zones, buy-side liquidity, sell-side liquidity, or imbalance. And it's not that easy to spot, but with time, if you practice, if you study, if you're not watching these videos like Netflix, you're actually sitting down with your notes, you will get these things, trust me. So now let's see some examples. Okay, take a look at this diagram. So we have this Wednesday open, that's this Wednesday, and this is the previous day, which is going to be Tuesday. So we have this buy-side liquidity where price dropped here on Tuesday, London Q zone. Price dropped that buy-side liquidity there, traded down, open here. You can see this is the accumulation phase. This is the accumulation for that day. So this is the accumulation phase of that day, which is towards within Asian session. So Asian session from 7 o'clock New York time to 1 o'clock midnight New York time. Price is just consolidating, and some guys go there to find setups on the 1 minute in this particular time. You can see what's there. There's nothing to trade there. There's no high probability setups there. You should be trading. You should be disciplined to ignore these sessions, and by this time you should be studying what occurred throughout the day, right? So after that, price still consolidated throughout London Q zone. Like I said, it the manipulation phase mostly occur on London Q zone, not like every day, right? So this manipulation accumulation phase extended to London Q zone, and London Q zone there was no setup there. So you were expecting what a bearish day, and price was attracted to previous day drawn liquidity that was created on Tuesday. That high is unprotected, and we'll talk about that. So price tackles that, then forms this sell side imbalance, buy side inefficiency, that's CB. Then price trade back into that FVG, you can see there, then drops again, the OTE or the simple entry model, then price drops again and trades back into that FVG again, then it drops down to the low of the day, forming the low of the day during what 3 o'clock to 4 o'clock New York time. So you can see this is the daily cycle, and this is what happens every day, just in different method, in different behavior. I'm studying the behavior of these things in one particular pair or two particular pairs will make you stand out in a matter of months. You will understand the behavior of that particular pair in months or in a very short period of time if you are actually really studying your ass off, right? So you want to understand this daily cycle. You want a new day opens. What are you looking for? You want price to make a fake move. This move, some traders will be induced to start buying, thinking that the day is going to be bullish. If you understand this move, right? If you understand this move, that this is the fake move. For some traders who trade support and resistance, this is their resistance, and price have actually broke that resistance. They want price to retest so that they can buy. But what does price does? It breaks, then drops back. This is a liquidity, a buy side liquidity. Now this is another diagram where price was attracted to a PDFVG, that's previous day FVG. So you can see here price dropped this FVG, created this OTE, higher time frame OTE. You can see it, price sweeps this high, price sweeps this low, then breaks this structure, breaks this high, leaving all of this imbalance here. And what happened? price accumulated towards what? During Asian session, price was accumulating. The London Q zone, price traded down to that what? MVD. Everybody will be thinking, oh, it's a bearish day, it's a bearish day. You can see that fake move that occurs during London Q zone. So I say the manipulation fees mostly occur in London Q zone. You can see it here clearly. This is London Q zone. The manipulation fees just dropped down into the MVD, and this could actually be a good trade, but I don't want to be looking for this. I want to be looking for the main distribution fees trade, the main move, not the fake move. So price traded into the MVD. You can see how price perfectly reacts to that MVD. You can see that this is algorithm, not buying and selling pressure. You can see how price dropped into the MVD, and the body of the candles are respecting that MVD. It dropped drops a week. This other one drops a week, but the body of that candle is perfectly respecting the MVD. That's an algorithm footprint before price actually was traded back up to this buy side liquidity created on a previous day Asian session high. You hear some guys say things about that, and most times you heard me say that today is like the continuation of what occurred yesterday. This week is the continuation of what occurred last week. This month is the continuation of what occurred last month. You can see this is where this day opened. This particular zone was where the day opened, and this was where the day ended. So price traded down here and was targeting what? Buy side liquidity, but did not get to that buy side liquidity before the day ends. Accumulated during Asian session, then immediately London Q zone the next day, price traded to that buy side liquidity, continuing what price was doing yesterday or the previous day. Some guys open their chart and think it's just a new day entirely. They want to look for new thing entirely. If you don't mark the price action or trace the price action of the previous day, the previous week, you find it hard to interpret or tell the price action of the current week or the current day. Please understand this, right? Protected and unprotected highs, lows, and the M.D. Protected highs are simple to find. Very simple. Once you understand the weekly A.M.D. and the narrative for that week. So if you've learned the weekly A.M.D., I believe you've learned. You know when price is accumulating, you know when price is manipulating, and you know when price is accumulating distributing. So if you understand this particular thing, you understand the protected highs. Protected highs and lows are simply highs and lows that price doesn't have any reason to take out until a potential target is achieved, like a draw on liquidity. So if there's a protected high, price won't take that protected high out to actually go for any FVG created by that protected high before it trades back down. So until price takes out a sell side liquidity or drops into an imbalance, price is not going for that protected high. That's what I do as a protected high. Price must do what? Take out sell side liquidity before going back for it. So when price takes out sell side liquidity, it's no more protected. It becomes unprotected high. This is going to be a topic for another day. Trust me, I'll talk about this. Now, unprotected highs and lows. As I have said many times, all highs and lows in the market are liquidities. Don't get this wrong. Every single high, every single low in the market are liquidities. They don't need to be equal, they don't need to be triple. All of them are liquidities, and price tends to take out these lows as a previous day liquidity. So if the today drops a low which is very much unprotected, price will come for it the next day as a drawn liquidity to come for it for the manipulation fees. That's just it. Before going for the next move, it wants that liquidity. It wants to take out stops before taking off, right? So there's a simple narrative around these specific highs and lows. Just one simple narrative, but this is going to be a topic for another day. So stick to this channel, subscribe, like the video if you've not already done that, so you don't miss out on the next topic. Turn on notification button, right? Okay, so now M.D. Okay, this M.D. is something I dug out from personal study and research. You will not see this anywhere, not in any YouTube channel, not in any thread you've ever read. This is just my own teaching, and after this video there's high probability you will see this in threads and other videos. There's high probability, but you know where it originated from. This is my own personal study. I'm not saying this anywhere. I've never learned this from anywhere. This is what I studied by myself, right? So the M.D. simply means manipulation imbalance. Yes, what does it mean? You might be asking yourself, what does manipulation imbalance mean? It doesn't make any sense. But this may occur on NASDAQ. So you should be very, very careful. I'm putting that as a disclaimer in case you go about trying it on Euro USD or GUSD or BTC or whatever. I've not tested it there. I've traded mainly NASDAQ. So this is what I know and this is what I've observed from NASDAQ, right? So at the beginning of the weekly distribution fees, this mainly occur on NASDAQ at the beginning of the weekly distribution fees. If you don't understand what I mean by the weekly distribution fees, please go back to weekly A.M.D. Now the M.D stays on field for the rest of that week, and this is pure narrative. So M.D is a manipulation imbalance that I want to see it on field. I don't want price to go to the I don't want price to go to have anything to do with that imbalance for the rest of the week. Price should just leave it on field. It does not act as a previous day drawn liquidity, does not act as a draw liquidity, does not act as anything, it's just there. Perfect imbalance, the price doesn't feel it. After the M.D, the next day is mostly a large range day. This is a one-side day. So if you are on the Telegram channel where I offer free mentorship to thousands of people, if you are not there, you can join with the description on this video. You will notice that I do mention these things most times, that I want tomorrow might be a large range day, or tomorrow might be a one-side day. You must have heard me mention these things before. Why? I've identified my M.D. Once I've identified my M.D, then the next day is a large range day. Why? Because M.D does act as draw liquidity, so price doesn't have any need to come and refill that imbalance. It just goes straight. Those days doesn't have anything with the previous day. It just goes straight. I think I talked about that in the last episode, the previous episode 17. Now, large range days have no manipulation fees. It doesn't react to the previous day drawn liquidity. But this is going to be a topic for another. Trust me, I'm going to talk about this like a topic on its own, right? So once a new day opens, it seeks for liquidity to fuel price to the actual move, thereby inducing traders to trade the fake move. So once a new day opens, this is the answer to that question I asked. What are you looking for? What are you looking for first when a new day opens? So once a new day opens, seeks for liquidity to fuel price to the actual move. So sometimes the fake move, the first move is not the fake move. This is what people get it wrong. The first move can be just going to take liquidity to do what? To go to the fake move, then come back again. That's 3 movements in a day. It happens like that. You just need to understand the behavior of the pair you're trading to see and know why those things occur like that. So once price takes out a buy side liquidity or a sell side liquidity, look for liquidity as potential target on the opposite, right? So if price takes out a buy side liquidity, you want to look for opposite sell side liquidity as your target and sell. You also want to wait for that simple entry model, then sell to the next sell side liquidity. It's not easy as it is said, but if you study, trust me, if you study, you'll find it simple. You find it simple. You just don't need to watch this video, then when you're done, you close your book. You just go to your charts, study these things I've mentioned here today. As you're studying it, you continue to see more clarity. You find peace with your trading. And for most of you following this channel, I'll maybe give you an assignment to try studying one particular pair for 3 months. Just try it and see the peace brings. You are an intraday trader, right? An intraday trader, you don't want to be trading multiple pairs. You want to focus on just one. So try studying and trading and practicing one particular pair. It could be NASDAQ, it could be US 500, it could be US 30, whatever. Just try and study that particular pair with this footprint I'm giving you for just 1 month and see how it goes, right? So this is everything on the daily A.M.D. I promised some videos, which the protected highs and unprotected highs and lows, and the M.D, and also I promised on the types of inefficiency. So if you've not subscribed yet, do want to subscribe. I'm going to be dropping more premium content like this. The next episode is going to be very hot one, so you don't want to miss that. So thank you. Share the video, like, and until next time, be safe.